Good morning and welcome to this AccountingWEB webinar sponsored by ABN AMRO Commercial Finance. We're broadcasting this live on Google Hangouts, and the topic of the webinar today is about client conversations with a focus on how you talk to your clients about their business, not just their tax returns. And it's really about the nitty-gritty of becoming a virtual finance director. Just a bit of housekeeping to start off with. We're going to have about a few sessions lasting about 30 minutes or so, where we're talking about some of the key points of how you go about having these conversations and getting the practical steps to becoming a virtual FD. And then we'll have a Q&A session at the end. So the video is available on demand, so we will be reloading that, and we're also running a Cover It Live session at the same time, so we very much welcome your comments to come in, and we'll try and answer those at some points throughout the webinar and also towards the end in a longer Q&A session towards the end. So we'll have a couple of polls as well. Right, so I'm the deputy editor of AccountingWEB, and just to give you a brief introduction of the rest of the panelists here, we've got John Stokdyk, who's the editor of AccountingWEB. He's going to be the voice of the AccountingWEB member and from our community. Nigel Harris is also a long-time AccountingWEB contributor, and he's going to be the sort of voice of technology and virtual FD. So he's a partner at Burton Sweet, and we've also got Simon Blake, who's a corporate finance partner at Price Bailey, who's also going to be giving a larger firm perspective and talking about asset-based lending in practice. So we're going to be talking about the rise of the FD, what it means for accountants, and what the reasons and opportunities are for going down this particular route. So we're going to explore what these conversations look like and how you go about raising the issue of finance with your clients. So before we kick off, if we could just go around, maybe if you start with John, can you tell us a little bit about who you are, what you do, and why you're part of the webinar today?
Okay, Rob. Well, I'm the editor of AccountingWEB, and a technology journalist is how I came into the role originally, but I sort of range across the whole field now of tax and practice. My main encounters with virtual FDs probably comes through our Practice Excellence Awards. We've had sort of probably between 100 and 200 firms enter the awards through the year and be measured by their clients. And it's very striking when you look at the results, the people who make it through to the shortlists, how many of them have provided actually do the business advice service. So that's what I'll be bringing in, sort of bringing illustrations and numbers from the Practice Excellence Awards and kind of what I've learned from talking to people like Nigel and Simon.
Great, thanks, John. And Nigel.
Well, good morning, everybody. I'm Nigel Harris. I'm a partner with Burton Sweet. We're chartered accountants based down in the West Country around Bristol. And I've been in general practice for a long time, basically, more or less all the time since I qualified with Grant Thornton, or rather Thornton Baker as it was in those days. But I've worked for all my professional life with owner-managed businesses, and increasingly these days doing what we're now calling virtual FD work, but basically hands-on work, helping people having those conversations about finance rather than just looking at last year's accounts and tax return.
Great, thank you, Nigel. And Simon, if you could tell us a little bit about you and your background, that'd be fantastic.
Of course, my name's Simon Blake. I head up the corporate finance or the mergers and acquisitions team for Price Bailey, a regional practice in southeast England. And I guess the role I find myself in quite often is that in helping a management buyout or a client with an acquisition, I get very, very close to the owners of that business, the directors of that business, And in the SME, the owner-managed environment, it's very common for there not to be a formal finance director, and therefore for the reliance on somebody like me to guide a client, guide a business through what often is a very major part of their business, an acquisition or the management buyout, and then all of the issues around that, whether it be the kinds of issues that our colleagues on this call are already involving, or particularly when it comes to finding the finance to acquire a business or to undertake a management buyout. There we build up such a close understanding of the business and relationship with the client, and match the funding and the funder to that client for the scenario they see themselves in at the time.
Great, thank you very much, Simon. That's, I guess moving on to the first session, we're going to look a little bit about what being a virtual FD actually means. So, and why it is more and more important, and certainly we're seeing that on AccountingWEB. So, if we could perhaps start with John, with Nigel. If you could just tell us what being a virtual finance director means to you, and maybe how your practice has changed over the years, and what sort of difference it has made to going down this route.
Well, let's perhaps just try and put it in context. Traditionally, the practicing accountant has been the guy that comes in after the end of the year, produces historical accounts, produces tax returns, and it's all very backward-looking, compliance-based. Within a large corporate entity, you will have finance controller, a finance director looking after the finance function, dealing with banks, lenders, finance raising, that sort of thing. But our clients are stuck in the middle there. They don't have in-house financial experts. Where do they get it from? Well, we're the obvious providers, and increasingly now, we and firms like us are providing that ad hoc virtual finance director, part-time finance director, whatever you want to call it, and providing the services as and when they need it, as an alternative to them employing somebody full-time of their own. And we're finding there's a steady demand for that sort of work, and I think any firm, if you look around, look at your client base, or look at your potential clients, there are people out there that certainly need that.
Great, and John, what does it mean to you?
Yeah, well, I'd echo the same point Nigel said about the kind of demise of compliance work, or the lessening margins. So all the practice experts emphasize that point. That, and in fact, the research, for example, from Intuit, shows that 4 out of 5 small business clients want their advice to give them sort of forward-looking ideas and strategy rather than just keeping score. And when that's backed up by our Practice Excellence Awards results. When you look at them, all of the top-performing firms have built that into their service and sort of have leave a sugar cube trail to step their clients up through that. So we can maybe go into the sequences, but it probably always starts with either a trigger, such as a need for finance or an acquisition, as in Simon's case, or so it could be a business plan. If there isn't the trigger, the firm sometimes will suggest it as say, look, they'll give a couple of hours away free and say, let's have a business review. Look at your business in the round, and that steps the client on to then, looking at KPIs to measure progress, and then reporting on those measures, and starting a kind of monthly or quarterly conversation. So that's the spectrum of virtual FD services as I see it.
Yeah.
And as I'm interested to hear from the people actually doing it, how they involve themselves with clients and take the relationship from there.
And John, of these sort of top performing firms that we're seeing in the Practice Excellence program, what are there any sort of general trends there that you can comment on?
I'd have to take my hat off to AVN here, because that sequence I've just mentioned, I mean, it's not a desperately new formula, but it's the difference amongst say the shortlisted firms, so the top 3 in each category, as opposed to the top 10, is they're actually doing it, and they will all have things like the one-page management report. They will have their profitability reviews, and they really do communicate to the client that they're going to do something besides just the backward-looking accounts and the statutory accounts and tax returns. So actually do it rather than just talk about it.
Yeah. Great, thanks, John. And I guess, Simon, you went from general practice to sort of a corporate finance role. In your particular corporate finance partner role, how has that changed over recent years? I guess what does a corporate finance partner kind of do all day, really?
I'm sure my colleagues will ask that as well. I think the key issue with corporate finance is that there's going to be some kind of transaction involved at some stage, an acquisition or a sale or a financing or a management buyout. But I suppose what's changed in the last few years, and the way I run my team, is that we are not interested just in that single transaction. We believe that the best way to add value to our clients is to be embedded with them and understand what their long-term strategy is. Their long-term strategy has to be there first before any transaction can be properly contemplated. Because when you buy a business, or when you're trying to grow a business, it's difficult, it's hard, it's exciting, and you need to be taking soundings from people that have done it before. And most owner managers haven't. They know how to win business from new customers and new clients, but many of them won't have ever been through an acquisition or bought a business themselves. They might have inherited it, they might have started it from scratch, but they haven't actually gone through the life cycle of buying an existing business that already has all of its own issues within it. So my role actually is to help guide our clients who haven't done that before through all of the potential pitfalls of that come about when you go from the idea of an acquisition or the idea of a management buyout to the reality. And that process will often take 6 months to a year. And because of that, because of the quite significant fees that we will often be paid as a result of that, we will be getting to know that client very, very well during the process. And I have to understand a business well in order to deliver them with what they really need, and deliver them the right financing solution, or the right target acquisition, or the right merger partner. And all of that, therefore, my role day to day is in bridging the gap between somebody that's never been involved in a corporate finance acquisition or a sale of their business before, with those that actually do it regularly, because usually the bank or the purchaser will have done it before, and they know how the game works, but our clients don't, and our role is to bridge that gap. And I think from the virtual FD perspective, a large corporate would have a finance director that has been involved in transactions before. An owner-managed business, such as Nigel's clients or my own, won't. They might well have a good financial manager or accountant in-house, or a financial controller who can be very, very competent at running the day-to-day accounting inside the business and provide the KPIs for the business itself, but they don't have the external strategic experience that we offer. And that's where the virtual FD role that I find myself in quite regularly comes into play. I mean, I could give an example just of this week with one of my clients who came in to see me on Monday, who is looking at how he copes with the insurance he offers his customers, and whether to consider a self-insurance route as opposed to an external insurance route. And that's a project he's asked me in a quasi-FD, virtual FD type role to explore with his existing partners and in the business, and with external parties that I can introduce.
Great, thank you, Simon. There's some good advice there for perhaps smaller firms who might want to learn from what a corporate finance partner does. Before we move on to the next section on sort of the practical steps to becoming a virtual FD and how do you actually go about it, we're just going to run a quick poll. So you can just say yes or no to the question, do you offer more virtual FD style services than before? So just a quick yes or no answer would be great. That poll should be coming up now. And I'm just going to take, I just want to remind everyone as well to keep the questions coming in via Cover It Live. I will be just taking one question now while we do run this poll. So, first question. Right, it's actually a question for Simon. It's come from Cover It Live. So, what type of business do you tend to work with?
Owner-managed businesses, typically with a turnover of, I don't know, probably no more than £5 to £10 million on a day-to-day basis. We do work with larger businesses, but most of our clients are probably of that size. Maybe profitable, maybe a startup, but typically, in the owner-managed space, in the small and medium-sized enterprise, where directors are often shareholders as well. There are not all the skill sets that a big corporate would have are represented on the board, so you might have a managing director with a sales orientation or a product orientation, and you might have an operations director, but you might not, well, it would be more rare actually than common for there to be a full-time formal finance director in that business. It would be much more common for there to be a full-time sales director, a full-time production director, maybe somebody on the operations side, and then a financial controller that is one rung below the board. That would probably be the majority of our clients.
Great, thanks, Simon. I just need to check if the results of the poll have come in. I will just actually do one more question. Do the panel members consider that their role as virtual FD exposes them to shadow or de facto director responsibilities? Never, sometimes, or always, and how far do you go? I don't know who wants to answer that one first.
Well, I'll kick off if you like. I think it's a very key question, and I suspect often it's a very close call, because the line between advice and decision making is often blurred. It's often fast moving. Ultimately, I act as an advisor, but I am working. I find myself using we language most of the time. I'm talking about the business as if I'm in it, rather than it being my client and a third party. But it's very clear ultimately that actually the directors and shareholders of that business have to make their own decisions ultimately, but they are going to be very reliant upon the advice I give them.
No, I would concur with that. I mean, it is a fine line, and you just have to be wary of it, really. Make sure that you are advising, not taking decisions. Having said that, we've got one client, at least I can think of, maybe more, but certainly one client where one of our partners is now the finance director. It got to a point where it made sense for us to join the board and then to find an independent firm of accountants to provide the compliance work, and that may well work for some firms.
Yeah, I think I concur with that as well. We've done that on a number of occasions in order to both, on the one hand, avoid conflicts of interest and meet our ethical responsibilities with our regulated bodies. But more importantly with that, actually ensure that the client understands the fine lines between decision making and responsibility and advice. and they are fine lines, and we will often talk with a client that there's going to come a point at some point where you need to employ a finance director, and that means you won't be using me in the same way. And we have those conversations often with other stakeholders in the business, like the bank, for instance, as well. I have one particular client where almost every time we meet with the bank, the question comes up is, well, when are you going to appoint a full-time finance director? And it's a real issue.
Yeah. I mean, in answer to Steve's question, I would add, the never, sometimes, or always, probably all of the above. I think the kind of thing about serving clients is the need to be flexible and to cater for their needs. So we've heard that, I think, Nigel does have one client who actually has gone the whole hog and has a sort of formal director. I think if your service line proceeds through to maybe also being the company, providing company secretarial services, and if that client wants you in that role, it would happen, and that's a case of again making the formal agreements and signing the proper sort of engagement letters and all the rest. Although, Simon, I hear what I'm getting from you is your firm will be quite scrupulous about drawing the line. So that's part of your how you address the market and you're involved. You probably have a much broader portfolio of clients than a lot of the AccountingWEB members. So and possibly with larger companies too. So it's much more appropriate to say right, you've reached the point, you're grown-ups now, take care of yourselves. So you're probably more able to say that to clients than more smaller high street practitioners.
Well, that might be the case, but I would hope that actually those smaller practitioners would also not fall into the trap of trying to do too much for their clients and end up in a position where they are crossing the line into shadow and real directorship, because that is a dangerous line to cross. And often in those circumstances, you can find yourself in a really difficult perspective. From a practice perspective, possibly acting outside of your professional indemnity insurance, for instance, meaning that individuals are exposing themselves to the rules of the fiduciary rules of the Companies Act as a shadow director, and not then being covered by the practice's PI because you're probably acting outside your engagement terms.
Interesting.
Thanks, Simon. And just the results of the poll have come in. So the question again was, do you offer more virtual FD style services than before? And 59% of you said yes. So that's the result from everyone who's viewing this webinar at the moment. And we will now move on to the next section, which is more about how you actually go about becoming, how does the small firms and practitioners go about becoming virtual FDs. So I'm just going to start with John. You mentioned earlier some of the experiences from the Practice Excellence Awards and the winners and the more successful firms there. Can you tell us a bit about some of the more innovative approaches that you've seen from really advanced firms?
Okay. One, and I think we'll probably return to this when it becomes the question of how you make the transition to being the virtual FD provider, service provider. I do think a lot of established firms, kind of with a strong compliance base, probably find it quite difficult to break out and establish a new model with their clients. So a lot of the ones making the running with this, I notice, are the kind of Generation X pioneers. These are people who've probably either come from finance background, business background, and decided to go into practice, or they're people who feel sort of constrained within the existing firm and set up on their own. And again, with the technology and with their, they'll be quite experienced and ambitious, so it gives them models. So I actually have an individual in my mind, Mark Telford, of Telford Associates in Kent. He was a former commercial FD who founded his firm in 2012. precisely because he saw the gap in the market for people offering this advice. So he's now been operating just over 2 years. His growth rates are kind of 50, 60, 70%. And just by offering virtual finance type consultancy to his clients, he says typically that can double his fee income from them. So the one innovation is if you can't provide it in the current context to your firm, a lot of people are setting up specifically to do so. The other innovation, as I say, I think we've Simon and Nigel do this more than me, but maybe we'll come back to this later, is the taking on the role of the mentor and actually focusing the directors' minds on their own development. I think there's a lot of training and development work that the really slick companies aren't just handing across the reports and saying, we need to look at your cash flow here, or how are we going to finance that expansion there. They're really sort of working on the director's own skills and responsibilities, as playing the role of a mentor that an FD might in the finance mentor that an FD might. I think that's a soft skill area that definitely is worth investigating.
Great, thank you, John. And then a similar sort of question to Nigel, I guess. I mean, what kind of benefits and opportunities did you find in making the transition to virtual FD?
Well, I don't want to spoil the party by suggesting this is something that we've always done, but this is something that we've always done, isn't it? And I think Simon and John will probably agree that...
Yeah, but Nigel, as we've had a question, you may have always done it. How do you start billing for it?
Well, that's exactly the point I was going to make. I think we've always done it. And when I look back at the partners of the firms I've worked with in the past, they've always done this sort of thing. They've done the mentoring, they've done the hand-holding when it's come to raising finance. But the difficulty has been packaging that as a service and selling it for what it's worth. And I think what increasingly now firms are trying to do is to separate the pure compliance work with this sort of advisory, consultancy, virtual FD role, and attaching a higher price ticket to it and marketing it as such. And the significance, I think, with what we're talking about now is that we're now starting to see some success in selling this in appropriate places. None of us are going to have many clients at any one time that need that service, but enough to keep us busy. And I would suggest if you haven't got enough and it's something you want to do, then you go out and find some clients that want it. There are clients out there that need it and who very much are not getting it from the firms that they're with at the moment. So there is a big marketing opportunity there. Which wasn't the answer to your question. Remind me what the question was.
Really about what opportunities did you find? What are the kind of revenue streams, and what are the main benefits of going down this route?
Well, one of the things that I think firms ought to think about is the things that they do and that they can do. And the most obvious starting point in this process is to look at management accounts. We're very good at doing financial accounts at the end of the year. What firms need, what businesses need to be able to make decisions is some up-to-date financial information. So why not just take that very small step from producing annual financial statements and help your client to produce regular monthly, quarterly management accounts? It's not a quantum leap. It's not something that you need a new qualification for. You've got staff who are perfectly capable of doing it. Your client may well have the software in place already. So you can extend your service to the client. Management accounts will then lead on to forecasting, budgets, that sort of thing. You can add a whole lot of value then to your basic accountancy skills. We're only talking about doing the things that we do all the time, but just repackaging them and selling them in an appropriate fashion.
Thanks, Nigel. And to Simon, what kind of how do you go about it? And do you actively seek out opportunities? Do partners refer you to certain businesses? How does within your remit? How do you go about talking to clients about sort of finance, funding, and business planning?
Well, I guess there's two main routes. There's because we're a larger firm, we have lots of colleagues who have clients that will have the needs for a refinancing or want to make an acquisition, and my partners will ask me to get involved with their affairs on that basis. But we also have plenty of opportunities to create those scenarios as well. And for instance, at the moment, there's a lot of interest in acquisitions, and so my team have been regularly involved in offering acquisition opportunities to existing and to new clients. In both cases, I think the points that we've been talking about and Nigel's been referring to there are really relevant, because I said earlier on the word strategy. Strategy is the thing that often our clients struggle to find the time to put in, and strategy actually is a whole combination of things. It's exit strategy. What's this business here for? What's it here to achieve? And what's the long game? Is there an exit planned here? And if so, what are we trying to achieve on that exit? And if that is achievable from the resources and from the business we have today, then so be it. But usually the answer is it's not. And there's a bridge to build around getting from where we are today to where we want to be. And strategy and consulting and that finance direct type role is absolutely key to being able to help those running the business, dealing with day-to-day sales inquiries, day-to-day production issues, day-to-day staffing issues, sucked into the busyness of all of that. The role of the virtual FD is actually arguably even more powerful than the role of a full-time FD, because it's actually one that's able to be slightly removed from the business and looking in and seeing the big issues as well as the detail issues. For me, for instance, in the last year or so, I've tried to ensure that when we are talking about management accounting and budgeting, we're talking about that not on what's happened since the last year end, but actually what's happened over the last 12 months to today, or to the most recent month end, and how does the next 12 months look from now? Unfortunately, from a financial accounting background, we get very hung up on year ends and tax reporting and financial reporting for Companies House. None of that is relevant to our clients. That's just compliance. That's just something they have to do because the law says they do. What they need to understand is what's changing in my business today, what's the trends in my business, and where are they headed? And so I'm, to my teams involved in day-to-day management account resources, I'm saying, run those management reports, run those KPIs on the basis of the rolling 12-month trends for the last 12 months and the 12 months ahead. And you get much more powerful interaction then between the operational business and the strategy by doing so. And that needs a little bit of work around how to manage that. Is it a spreadsheet? Is it a financial model? Is it some software? But actually it also needs a lot of interpretation, and that's what that virtual FD person is able to then bring to the table and say, well, look, your trend over the last 12 months, you've been seeing month-on-month growth in these areas, but also month-on-month issues in terms of cost base changing or staffing or ratios changing. It's very live, very pivotal information that's coming out then that is going to help show everybody interested in the business, whether it be a funder, whether it be an acquirer, actually what's going on today, rather than what was actually happening in the business last 31st of March when the last accounts that are currently available were produced.
If I can jump in for a second and put my technology hat on, I'd be very curious, Simon and Nigel, when I've just heard both of you describing those scenarios, the degree to which cloud accounting plays a role in having those instant insights and as the platform for advice. Does that make a lot of difference to the model?
Well, I think cloud account. Sorry, Nigel, go ahead.
I think it will do. If I just think through in my head the clients where we're most actively involved, I think they're all Sage users. So they've got in-house desktop software. I mean, we have remote desktop access to one or two, but the cloud accounting clients are probably the newer ones. They're not yet of a size that need a sophisticated virtual FD service, but it's something that we're packaging with that now. And increasingly, we're finding that the clients that are taking on cloud software, zero cash flow, whatever, do want some more hands-on advice because they know that their data is almost real time. So they're saying, well, why can't we have some real-time tax planning commentary So it's definitely the tool going forward. It's something that we're looking to make much more use of, because I can be sitting at my desk, I can review 20 different clients' current management accounts in the space of a couple of hours, rather than being going out visiting each of them and taking a whole load more time. So way forward, but I don't think we're there yet.
I've noticed even in the last 6 months actually that there is a huge opportunity here to bring together through packages like Xero the ability for us to be much more focused on what's happening now in the business, and our roles I think are going to change in the next few years to be much more about ensuring those clients have got their Xero accounts or their cash flow accounts up to date right now, and they know, and they're not needing lots of editing to them, and so that actually at any one time, what I described about that sort of 12-month rolling backwards, rolling forwards position is actually really prevalent in the information in front of the managing director, in front of the team running the business. And I actually think it's really relevant to those businesses coming in with new businesses onto the cloud right now, or existing businesses as well, because they have the ability. They are very close to being able to have that knowledge in front of them. I don't think all of the packages can do that in isolation, or one software piece, whether it's Sage or Xero or Cashflow, can give all the answers. I think every business actually needs to use those tools to produce from there what is most relevant for their business, because every business is different. You cannot standardize the reporting for every business. The more you spend time with individual businesses, the more you realize how unique every business is from the next.
That's great. Thanks for your views there on technology. We've just got time for a very quick poll, the second and last one, in fact. So we're going to run that right now. Do your clients ask you about advice on growth? So again, simple yes or no answer be great. And one more very quick question. So this is again come from Cover It Live. So keep the questions coming in. We will get to them at the end of the presentation. We're just sort of dropping one or two in throughout. So I guess this one goes to Nigel or Simon. But are your clients normally honest with you about why they want finance? I don't know if either of you want to answer that, or both.
Yeah, that's a very strange question, isn't it? I'm not entirely sure what's behind that question, but yes, I think. And of course, within the role that you've got as a virtual FD, if you're looking under the bonnet, looking at the figures, looking at the management accounts, then you see the reality anyway. So I'm not sure that that's ever been an issue for me, but Simon may know found differently.
No, I think that actually when I am working with clients and they are looking at funding, there's a very obvious and specific need for that funding. And not only that, there's no point fooling yourself that you could go and raise finance from somebody that you're going to use it for a different purpose to the purpose that you have asked for. Every funder, whether it be an equity funder or a debt funder or something in between, will use will undertake due diligence properly to understand exactly. Not only that, because they want to understand what the potential returns are. The only exceptions to that are outright fraud, and the virtual FD, if he isn't, if there is some other reason for that finance to be raised, the virtual FD ought to know about it, frankly. I suppose the most likely scenario is actually where a business is perhaps in more trouble than they might be willing to admit, and want to perhaps trying to cover up the full extent of their problems. But the reality is I don't see that as an issue. I see that actually clients are very transparent about what they're looking for funding for, and the issue is more often actually, and possibly one we're going to come on to, which is actually getting the right kind of funding for the scenario that the client's situation reflects, matching equity to equity needs and matching debt to debt circumstances.
All right, thank you, Simon. And one more question from the community. How is a virtual FD different to a part-time FD?
I think a part-time FD is somebody that is immediately recognising that their responsibility is as equivalent to a formal finance director. It's just they're not spending 365 days a year in the business doing it. Whereas a virtual FD, I think, is much more likely to be a third party to the business, probably typically a professional with many different virtual FD type roles, and probably like ourselves on this call in a practice environment. The part-time FD is probably somebody that's got 3 or 4 FD roles, I would say.
Great, and the results for the poll have come in now. So we've got a resounding yes to the question: do your clients ask about advice on growth? 69% yes, that's 31% no. So that's clearly clients are asking those sort of questions. So we're moving on now to the final section before we have a Q&A session at the end. And this is all about the actual conversations. What do you talk about, the transition to being an advisor, and what these virtual FD conversations actually look like. So I'd like to start with Simon. If you can perhaps give us an example of the ideal scenario for the asset-based lending journey in terms of a sort of beginning, middle, and end of conversation.
Well, it probably connects with the comment about growth that we've just had, because in today's world, traditional businesses often didn't take much debt on, but were creating assets that actually, in the world of today's asset-based lending community, are eminently fundable. And that funding, without most asset-based lending, invoice discounting, for instance, is a very good example, is not something that you are constantly having to pay down in loan repayments. It's something that's revolving with your business, and therefore it's a very powerful finance tool. So we see many acquisitions today funded by businesses that don't need working capital finance for their existing business, because they've reinvested over the years in building up their business so that it stands without debt, but they then use asset-based lending, invoice finance particularly, or stock finance occasionally, to then secure a line of funding that they are going to pay interest on, but are probably not really going to actually repay capital on for some time, and certainly not in a formal way, more in an informal way. And they use that funding to undertake an acquisition, or to undertake a major growth phase of recruitment, for instance, in their business. And asset-based lenders are very, very good at being able to identify how they can resource a business to achieve those objectives. A typical trading business that has invoices where they are delivering goods or services each time with a delivery note or a timesheet, is able to raise finance within a couple of days of that invoice from an invoice discounter and draw down the majority of the cash in that invoice, including the VAT element if there's VAT on top, and use that cash in their business in a couple of days, rather than wait for the whole cycle of a debtor to pay that invoice in 60 or 90 days on.
Great, thank you. And Nigel, does it match how you want these sort of conversations to work as well?
I think in most cases it's a conversation that we need to be leading as the accounting professionals. There will be some clients that kind of have some idea of what they want and need a bit of hand-holding, need a bit of guidance. but with a lot of clients, they know they want to grow, or they're suffering growing pains, they're coming up against cash flow issues. So it's an opportunity for us to introduce the whole conversation about finance and say, well, are you aware? Because many clients will think, well, we just have to raise an overdraft. So you have to disabuse them of that notion and go, well, actually, overdrafts are so last year. Now, asset-based finance is the way banks want to work. 20 years ago, nobody was doing invoice-based finance, factoring or whatever, unless you were turning over multiples of millions. These days, startups can get invoice discounting arrangements. So you look at the assets that they got. Have they got debtors? Have they got plant and machinery? Have they got stock? There are funding solutions to cover all of those, as Simon was saying, and that's increasingly now the way that banks want to fund businesses, and businesses have to understand that, and the way they're going to understand that is probably through the accountant or the virtual finance director explaining what the options are as an independent advisor, rather than the bank trying to sell them something.
And one of the challenges there regularly these days is just to help explain that the world doesn't view asset finance, particularly factoring, in the way that it viewed it 10 or 15 years ago. Back then, factoring was a big no-no. It was something that you only did when you were in desperate measures, coming towards insolvency or something like that. Now it's quite the opposite. You know, a business that isn't invoice discounting its debtors, if it can, is almost seen as not using its assets properly, and actually, you know, almost wasting the availability of funds to that business to grow. Now, one would say that in the past, perhaps that was a much more prudent and traditional way to act. In today's world, is why we got ourselves into so much trouble with the recession, with banks overlending and clients overcommitting. But there's clearly an opportunity there between those two extremes to use asset-based lending very powerfully to build our businesses day to day. You know, there's a very large number of businesses that will now have the opportunity to grow because of the asset-based lending that's available to them.
And this actually relates to a question we've had from the community. I guess, do you start with the bank for finance? Is that your sort of the first place you would go, or would, you know, would you go straight to the asset lending?
I think actually the banks start with the assets today in today's world. Whatever happens, a bank wants security for their lending. And the best security is the assets of the business. And picking up on Nigel's comment about the old days of overdraft and the new days of invoice discounting, for instance, that's all simply down to the quality of the asset that the bank can get security on it. And there was for the detail, there was a case actually in the New Zealand courts about 15 years ago that changed the attitude towards security, which is why banks' focus will always be on, well, what assets are you offering me to secure the loan against? The wider question is the need a debt need, or is it something that requires equity finance for? And actually that's where the conversation for Nigel or myself will start more often than not. Is actually, what is it that you are looking to raise finance for? When you understand that question, you can then move on to which channel you're heading down, whether it be asset-based finance, leverage bank finance, equity finance, mezzanine finance, private equity or venture capital, business angel, or friends and family.
Yeah, it's a matter of helping clients to understand what is the most appropriate finance, isn't it, for a particular transaction. I think that's where we've got a lot of experience to bring in to help that initial conversation before we start to approach lenders.
Great. And John, with your experience on AccountingWEB, do you think clients want to work in this way?
I think very definitely. I mentioned that figure at the start, there's sort of 80% of people wanting their client to provide business advice and you know, solve problems rather than just tell them what's going on. It was nearly 60% of the people we're already doing this. That's higher. The people who've come to this session, I think, are more advanced than the wider market. And it was again very the clients asking about growth was phenomenally high as well. Just to go back to the Intuit thing, though, that it's hard to emphasize there is still a gap here between that need and what people are doing. As I say, people here are doing it more so. The Intuit figures from last year, they used the example of project finance and management services that they wished their client had provided. Again, that was 81% of clients wanted it, but only 36% of practitioners. So yes, they do want that. I think clients have wanted it through the ages. They've probably got it informally. So the difference here is the packaging, how you get them to sort of recognize the value, appreciate it, and pay for it separately. I think that's the nitty-gritty challenge we need to solve.
Great, thank you, John. And I guess just to we're approaching the Q&A session now, so we've got a few minutes left for that. But I just want to ask each of the panel members just to give us your one key takeaway from the session before we get into the Q&A. So perhaps if we start with Simon, if you could just give us that takeaway, that'd be great.
I think for me, the issue of a virtual FD is somebody that has to have a very strong relationship with the business, that understands on a day-to-day basis the needs of that business without having to spend every day in the business. So that's down to relationship, that's down to being involved in all of the strategic conversations that are going on in that business and not getting bogged down, arguably, with the day-to-day financial transactions that a full-time FD might.
Great, and Nigel, what's your takeaway?
I think my one tip to listeners, viewers, would be to look at your client base. Look at the clients who are potential customers for this type of service and go after them. And be honest, if your client base is all window cleaners and hairdressers and none of them need that service, you need to go out and market yourself to potential clients. But start having that conversation, and I think as John suggested early on, maybe you need to offer some free initial sessions with some of your clients just to give them a taster and say, well, actually, this is a new service we're offering. This is what it looks like. Here's a flavour, and then stick to your guns. Don't give it away. So look at your clients. Look at who might be a potential customer. It won't be all of them. So target the specific ones, and you will find one or two takers, I'm sure.
Thank you, Nigel. And how about you, John?
Well, again, to wrap up the knot here, just do it. Really, I think experiment. If you haven't got a package going, work with one of your trusted clients or someone, or find a new one. It's like practicing the piano or skiing or something. You really develop that skill by doing it. So work with someone where it's as a self-contained, containable, damage limitation environment. See how it works initially, then review what you've done with the client, and then if it works, replicate the model with other suitable people.
Thank you, John. Now we've got a few more minutes just to take some more questions. So just kicking off into that. If you were to recommend a finance provider to your client, what criteria would influence that recommendation?
I think I probably covered most of that in the last piece I talked about. You've got to firstly understand exactly the need and the nature, not just the need in terms of the project itself, but the background of the business that it's coming from. And then you can assess whether it's equity or debt, and whether there's asset finance available to the business to use in that scenario or not, or whether actually the assets are not sufficient to raise the capital required, and therefore you need to look outside, and that's where perhaps equity or leverage finance becomes more appropriate. I
mean, it sounds to me, Simon, like experience is very helpful here. You've probably now helped with so many different scenarios that you'll be able to spot the parallels, and you'll know, you'll know which arrangements worked well in the past, and the providers you found easy to work with, and who the clients found easy to work with. I imagine as you practice more and build up experience, that gets easier.
You're right. It's experience to start with, but it's then also current relationships secondary, because the current relationships with what's happening in the banking and the finance and the equity communities are vital, because to deliver the result that the experience tells you need to achieve for that client. And that we see lots of movement around the banks of both individuals but also attitudes. Take Cooperative Bank as an example. At the beginning of the recession, Cooperative Bank was lending very strongly into many scenarios that were good scenarios, but other banks were not interested in. But right now, we're now exiting many of those scenarios because of what's gone on with the Cooperative Bank over the last few years. And yet the managers that I was dealing with in the Cooperative Bank 5 years ago are now in other banks, and my relationships with them continue, but they've got a different bank that they're attached to. And also, I think it's true to say that the asset-based lenders are breaking free of the traditional banking environment more and more, and coming up with more innovative attitudes, more traditional banking type approaches sometimes alongside their asset-based lending approach. And so that is down to relationships and understanding that. So for myself, I need to spend time not just with my clients looking at their personal scenarios inside their businesses, but also with the funders and understanding what the funders' attitudes are towards the market, what they're looking for, and who's going to be the right partner for the right scenario.
Thank you, Simon. And one more question about how you get clients to sort of pay for all of this. I think John talked a little bit about this earlier, but the question is, given that virtual FD support is likely to require partner-level resource, how do you charge rates for this work fair against other traditional work? Don't know if
Anybody want to answer that one? Well, you stick to your guns, don't you? It's absolutely crucial that you value the service, because otherwise the clients won't value it. So in most cases, we look at partner hourly rates, and that's what we charge. It's going to be hourly or daily work generally. It's not something that very often we can do on a fixed price basis or a value added kind of basis. And clients generally are happy with that. You do have to soft them up a bit and say, well, look, this is high value stuff. You're going to have to pay for it, and if they're going to value it, they will pay for it.
I guess this is where I tend to focus back on one of the points I made earlier on, which is there is a time and a place for a virtual FD role, and there is also a time and a place for a full-time FD role. And one of the issues between those two is the cost. Most businesses can't, would be appropriate for a virtual FD, can't afford a full-time FD, and therefore there's a cap in terms of the total cost that actually that business can afford for the virtual FD role as well. And somewhere between where the business is today and where they are at a point of employing a full-time FD, there's a timeline there between the role that Nigel and I can play on a day-to-day basis, which might start off being a morning a month. It might become a day a week.
We seem to have lost Simon there. I didn't have much to add really to either Simon or Nigel's point, but if I was reluctant to step in there, it was because I think I would have to have answered that we do get into value-based pricing territory, and from all of the history that's generated on AccountingWEB, we would need another hour, a separate hangout to probably tackle that.
Yes, actually, John, our hour is up, so I'm just going to wrap things up now. We have had a lot of questions come in, so we will try and get those questions. There's an interesting one on marketing, actually, which I was going to ask, but we'll try and get some response for you and put that up on AccountingWEB for everyone to look at. So thank you very much for all your questions. Also, we want to thank our sponsors for this webinar. That's ABN AMRO Commercial Finance, who have been great, and thank you very much for your involvement in this. And also to the panel members for sharing their insights from the AccountingWEB community to Burton Sweet and Price Bailey. So thank you very much.